Welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals today, and main focus is going to be on the US dollar and JPY. Definitely we will be seeing other instruments as well. Should you have an instrument you would like to have a look at, let us know in the comments. And if we don't have any time today, we definitely may have some time tomorrow. For the time being, we have in front of our screens Euro USD's daily chart. Now we would be noting here that practically the pair is in an ascending mood, upward mood. That's more than clear. And at this point, it would be interesting to note that the day-to-day opened with a negative gap. And allow me to drill into the 1 hour chart here to show you more clearly. Now there had been a negative opening gap at today's opening, which tended to imply some bullish tendencies on behalf of the US dollar. Yet they were quickly overcome, and the price action is currently at the same level it was when the day closed on Friday. Back to the daily chart. Definitely the R1 has to be switched into a support line, given that the price action has moved above it. And let's go hunting for an ultimate resistance line. We have a nice peak here. However, allow me to draw it a little bit higher. And I'm going to once again drill into the 1 hour chart, show the resistance level, and be able to measure it more exactly. Going back in the chart, back to the 4 hour chart. And at this point, we can calibrate it even better. You can see the touch right here and here. Could go a little bit high. In my opinion, though, I'm going to keep it at that peak right there. And it's now being placed, the R3 at 1.104. Locking it in. Back to the daily chart. That's about it. Let's also correct the labels. Starting with the R3 at 1.1040, the R2 at 1.0980, the R1 at 1.0915, the S1 at 1.0860, the S2 at 1.0815, the S3 at 1.0765. Now I see that we have a request to practically also draw, all the resistance support lines on the chart. Definitely we can do that. And one resistance level would be definitely the peak here. I think that's more than obvious. On the downside, I would be noting this show in green, and another one would be at this level. Now there may be some intermediate levels which could be added, but the rough picture would be about so, in my opinion. If we could also apply, we have a question about applying Fibonacci levels. Okay, Fibonacci levels right now are missing out. We are hitting one level right here, which seems to be valid. We're missing that. Another level is being set on this peak here. Could be valid pretty close to ours. Another level right here. However, I do not seem to find any throws or peaks here for this one. And another one right here, which seems to be very close. It's the 61.8, and it's pretty close to our first resistance line. I'm not a big believer in Fibonacci levels, but there are lots of traders using them, so one should not actually bypass them. It's a good question. And for the time being, we tend to maintain a bullish outlook for the pair. Expect Euro USD to breach the 1.0915. We definitely need a higher peak than this one. And start aiming for the 1.0980. Now, in my opinion, the upward trend line is supported by two factors. Definitely the one is the upward trend line, which remains intact. No questions asked about that. And as long as the upward trend line remains valid, we maintain a bullish outlook. The second factor which we would be highlighting would be the fact that the RSI indicator is nearing the reading of 70, implying rather strong bullish sentiment among market participants for the pair. On the flip side, sorry about that, I would note the fact that the price action is flirting with the upper Bollinger Band, which may be a reason for the bulls to slow down, or even we may see a contraction, if you prefer, a correction lower. I would be also noting that there is a relative difficulty to breach above the 1.0915. And that's why we are highlighting the necessity for the bullish outlook to continue, for the pair to breach above the R1. Now we have a request about Euro USD. I don't have it on the chart, but allow me to open it, and we're going to do it from scratch. Let's find it. It's show all. Euro CAD, Euro NZD, Euro AUD. New chart window. Drilling to the daily chart. Zooming in. Definitely we're going to be using a candlestick. Zooming further in. I would like to see more detail here. Okay. There is an interesting element here. And I would note that we have relative stabilization of the pair over the past 3 weeks. So the big picture here is that the pair was dropping. There was an intense downward motion right here. And let me color this in red. Which has been interrupted. The pair now moves in sideways motion, and let's set some boundaries on the upside. First resistance line, I would be setting it right here. It's a beautiful peak, and if we drill into the 1 hour chart, it will become even more obvious. Note the test. Back to the daily chart. I would be setting the second resistance line. It's a little bit far off, I know it. And I'm going to be keeping wide corridors between the resistance support lines. And the third one on this peak here. Let's move now and have a look at support lines. In green. Let's do it in lime green. Should be more obvious. Let's go back and have a look where we can find more truths in order to set more support lines. Second one, and I would be placing another one here. Could go a little bit lower. Note this peak here, and there is some level right between these here and here. There has been some commotion a couple of times. Let's readjust the chart. Sorry about that. So we have one resistance line in red, the R3, which is being set at 1.6685. Let's correct that. Next one should be at 1.6405. Now, please bear in mind that these are approximate levels. We're talking about resistance support areas always. And the second resistance line, the first resistance line being set are one at 1.6170. Let's lock in the resistance lines. Let's move now to the support lines. The first in mind seems to be the 1.06. Let's have a look at that. Yep. It's a little bit higher than the actual true, but it's a nice round figure. I want to keep that. The first is set. The second support line seems to be around 1.5845. And the third one being set at 1.5660. 65, sorry. Now at this point, one could finish it off by stating that the price action has moved in a downward fashion. However, that downward trend line has been broken. So now it tends to remain in a sideways motion between the R1, 1.6170, and the S1 1.60. We're talking about 170 pips corridor here. I would like to see a couple of other things though as well, and one would be the Bollinger Bands. In light blue. Okay, they're converging. And the second, I would also like to see the RSI indicator. Let's move to the oscillators, relative strength index. Let's have a look at the properties. Indicators list. Deleting it. Let's put it in new. In white. Here we are. Can narrow it easily. Let's position the labels. Widen the RSI. Sorry. Now, we opened the Bollinger Bands and the RSI indicator in an effort to have a look at more qualitative factors which could overturn the initial sideways movement bias. But I have to note here that we're getting some mixed signals in the sense that on the one hand, we have the Bollinger Bands which are narrowing, and the fact that they're narrowing tends to imply a low volatility which could allow exactly the sideways motion to be maintained. That's one. On the other hand, though, I would be noting that we have an RSI indicator which remains near the rating of 40, which tends to imply the presence of some bearish tendencies among market participants, which could drive the pair lower. Note also how the 20 moving average, which is the median of the Bollinger Bands, that's why you can see here also the number 20, tends to remain in a downward fashion, downward slope, which has failed to pick up the sideways movement of the past 2 weeks. 1 week, sorry. So we tend to maintain our bias for the sideways motion. For a bearish outlook to emerge, I would require the pair to actually breach the 1.06 and start aiming for the 1.05845. Let's have a look in more detail in the 1 hour chart. We can see how the stabilization is even more obvious here. So the sideways motion is being maintained here. That's my opinion. Should the bears take over, Once again, we would require for a bearish outlook the pair to breach the S1 1.6 and start aiming for the 1.05845. One other outlook, which is quite interesting, would be a more macro outlook, and that would be a downward trend line like here. We had one peak, a lower peak, and now a third lower peak seems about to form. One true, lower true, but that's a little bit far off on the horizon. You would need another week or so to meet that level. So in a more short-term perspective, once again, sideways motion seems to be maintained. I hope that more or less answers your question. By the way, I see that you seem to have been interested also about cryptos. Have a look at Bitcoin's movement upward yesterday and today. That was quite interesting as well. Okay, back to our charts. Let's have a look at USD/JPY. Now, the big picture is that the price action has dropped, and I would like to show you something here. And allow me to drill into the 5-minute chart. Let's forget about resistance support lines. Let's go back. Now, this is what I would like to show you. And allow me even to drill into the 1-minute chart. It's even more obvious. Going for the 11th of July. Now, there has been lots and lots of talk about a possible market intervention by BOJ. That was on Thursday at the release of the USCPI rates for June. And it's quite interesting. Now, what we're seeing right here was the initial market reaction to the release of the USCPI rates. You can see a drop of USD/JPY, which was very obvious, and it was practically a weakening of the USD side. That was something which was evident in other pairs beyond JPY. But JPY pairs had a unique characteristic, and that was the fact that despite other USD pairs showing a weakening of the US dollar and stabilizing at low levels, USD/JPY has a renewed and far more intense downward motion about 15 minutes later. And that's what initiated the speculation for a possible market intervention by Japan. Now, we can see how there was a market reaction initially, but Bank of Japan seems to was sticking to it, and the pair dropped to 157.70. I would say even lower. That could go up to 40. Logging it in. See the stabilization? A little bit higher. And at some point, the market started selling the yen again. See what happened here. It's moved upwards, and then Japan intervened again. Once again, the market reacts, pushes the pair higher, and we have another intervention, and it's not over yet. Note how the market pushes the pair higher, another effort, once again up, and then we reach around. This was the last major market intervention here, one and another one, and things have quieted down after that. Why? Because the price action of the pair remained in the low levels and is now currently trading at around 157. It was a very, very interesting market reaction. Back to the daily chart. Now we definitely have to switch the role of the 160.20 from a support line to to a resistance line. One could even lower the 163 down all the way to the 161.92. In my opinion, that's a little bit far-fetched. I'm going to be keeping the 163. Let's reposition and correct the labels, starting with the S3 at 151.85, the S2 at 154.60, the S1 at 157.40, the R1 at 160.20, the R2, as mentioned, it could go lower, but I prefer to keep it all the way up to 163. The R3 at 166. Now the big question here is where it's heading to. But before we talk about that, allow me to show you another thing. Now, there is a very wide, if we drill into the weekly chart, a very wide upward channel. But there is a catch. If we drill into the daily chart, there was a minor channel within the channel, and that was something like here you go. Could place it right here. This could go upwards like here. Now, this upward trend line is not needed anymore. Neither is this. They are all obsolete. And we can see how the price action stabilized after hitting the boundary of the upward channel, which was seen in the weekly chart. Allow me to drill it, to color it, sorry, in orange, so we can differentiate. While the price action in its correction lower after the market intervention is about to breach the low boundary. Now, should the low boundary be breached, given also that the price action respects the 157.40 support line, that implies a relative stabilization of the pair. And we would require for a bearish outlook for USD/JPY the pair to breach clearly the S157.40 and start aiming for the S254.6. For the time being though, and as long as the S1 is holding ground, we maintain a sideways motion bias. For a bullish outlook, the bar is pretty high. The pair has to breach the 160.20 and start aiming for the R2 163. Now, on a technical level, I told you we would be concentrating on the US dollar and the JPY. I'm going to be focusing on the fundamentals here as well. Now, we have a number of financial releases which span across the FX market. I would like to concentrate on two issues. A, the possibility of a market intervention by the Japanese central bank, or by Japan if you prefer. And should we see renewed efforts, because I'm not totally convinced that it's over just yet. If you see the price swing of the past intervention, we were talking about 800 pips. This one, you're talking about only 440. So we may see further attempts of Japan to actually drive JPY higher. That would mean practically drive USD JPY lower. So be on your guard for the next couple of days, because the last market operation by Japan lasted 1, 2, 3, 4, 5 days. It's not something which is instant. It's something which could span for a couple of days. We have a question here about the US dollar being stronger than this week or not. Actually, I was hoping also that it would be stronger. And I was basing this especially after the assassination attempt against former President Trump yesterday. We expected that we could see some safe haven inflows for the US dollar at today's opening, which actually occurred. That was the case. But the US dollar started weakening in today's Asian session already. That would imply that practically the uncertainty which was characterizing the markets during today's opening is easing. And on the contrary, I would be saying that the market's expectations for a possible Trump election seem to be enhanced. And if that's the case, then we may see riskier assets, and that includes also cryptocurrencies, being supported, as could also US stock markets. Why? Because Republicans could be more in favor of deregulation and tax cuts. And such tendencies on a political level tend to provide more business opportunities and allow more freedom for cryptocurrencies. That should sum it up for the day. I hope you enjoyed our report. From all of us here at IronFX, best wishes for solid trading.
And just get started. So, okay, let's get started. So, as per usual, a risk warning and disclaimer. So, our products are traded on margin and carry a high level of risk, and it's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risks involved. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. So I'm Melanie, and I am an investment analyst from Everest Fortune Group, who were finalists for Best FX and Equity Research in the years 2019 to 2021. So here is our agenda for today. So firstly, we'll go through which timeframes you should use for swing trading. And then we'll look at some graphical key elements, followed by identifying momentum. So this will be pretty similar to last week's momentum, where we talked a bit about the different indicators that you can use to identify the momentum. And then we'll look at breakouts versus reversals, as well as using correlation to fine-tune your strategy, because that tends to be pretty useful when you are looking at swing trading. So just let me know in the chat if there are any of you guys who like to use swing trading. I'm just curious to know as well. Okay, so here is a clear market structure example. So this is kind of the structure that we're looking for when we are going in for our analysis or choosing which timeframes to use. And this is an example for an unclear market structure, an example that we want to kind of stay away from. Okay, so which time frame is the most important? For swing trading, okay, so before I get into that, I just want to show you guys that the more important thing is to look for clear market structures. So you can see on the M15 here, it's pretty unclear market structure, whereas on our H1 view, it's pretty clear shape. Yeah, so there's two criterion here. Firstly, we want to look for a clear swing low or clear swing high. And secondly, we want to look for a clear trend between the starting and ending point. So this can be used for support and resistance levels. If you're using pivot points indicators, that works as well, and even your Fibonacci levels as well. So as for which timeframes to use for swing trading, these tend to be on the higher timeframes. So 1 hour to about your daily timeframes. So like so H1, H4, and the daily timeframes as well. Those tend to be used for swing trading. But as I mentioned, it's more important to look for clear market structures when you are determining which chart that you want to use. So I'll just do a really brief introduction to multi-time frame analysis. We went through this last week, but if you weren't here for our previous webinar, which was on day trading, I'm just going to briefly talk about this in this slide. So typically, traders will choose at least two time frames, such as a shorter term time frame and a longer term time frame. So it's basically a strategy that involves analyzing the market from multiple time frames so that you get an idea of the general trend of the whatever commodity or currency that you are trading. So the short time frame is used to identify the most recent trends and price movements, while the longer time frame is used to identify the overall market direction. So you want to look for key resistance levels, trends, and patterns. And these tend to involve looking at your indicators, looking at your Fibonacci levels, so on and so forth. So for example, if the short-term trend is bullish and the longer-term trend is also bullish, this could indicate a strong uptrend in the market. So conversely, if the longer-term trend is bearish, the trader may look to sell or short the market. As also if the shorter term trend is also bearish, then you would know that there is an indication of a strong downtrend in the market. So overall, multi-time frame analysis tends to help traders gain a better understanding of the market and gain more informed trading decisions by analyzing the bigger picture and trends and patterns from multiple time frames. Okay, so what exactly should you look out for? So price action wise, okay, these are obviously some of the basics that you should look out for on the higher time frames that you use for swing trading. But of course, in terms of price action, we're talking about past, present, and future momentums from the previous bar to dictate your strategy. So that brings us into our next point, which would be identifying momentum. Okay, all of these are kind of just tools that you can use to identify momentums and key levels. So the first key graphical levels, horizontal levels includes like your support, your resistance, and these tend to be supported with your Fibonacci levels, and including looking for Fibonacci confluence areas, so on and so forth. But we'll get into breakouts as well as Ichimoku clouds in the next few slides. And if we have time, I will also show you guys how exactly you can use these on an actual chart. Okay, so here, let's go through a couple of momentum indicators. So firstly, we have the MACD, and the MACD stands for Moving Average Convergence Divergence. So this line is calculated by subtracting the 26-period exponential moving average, or EMA, from the 12-period EMA. So the signal line is a 9-period EMA of the MACD line. Okay, so basically it uses three exponential moving averages to identify price movements. And the difference between these averages is shown in a histogram, which you will see in the next slide, which is just the charts. And then, I mean, the graphs. And then the movement can show whether a trend is strengthening or weakening. However, moving averages always lag behind price action and are more suitable for identifying entry points. So the MACD triggers technical signals when the MACD line crosses above the signal line to buy or falls below, which is a signal to sell. So here is the example of it, just so that you get an idea of what I'm talking about. So the MACD line is the blue line, signal line is the orange line. The histogram that I mentioned earlier is just your bar charts or graphs over here. And then your zero line is, of course, just the dotted line there. So a selling signal occurs when the MACD line crosses over the signal line. And then the bullish or buy entry is over here. So when the signal line crosses over the MACD line. It's just the opposite of here. Okay, so this is an example, and our sell entry is over here as well. So basically, you just want to take note of each of the crossovers because that um tends to indicate a change in trend or change in direction of movement. Yeah. Okay, but it's important to note that these tend to be lagging indicators as well. Like you can see over here, um, only when price has shown a reversal, then the next few lines, then we see price crossing over and indicating. So basically the red area indicates a sell. So this, yeah, it's pretty much a lagging indicator. So just keep that in mind if you're intending to use your MACD. Okay, let me know if there are any questions throughout the webinar. Okay, next momentum indicators, we're going to look at RSI as well as stochastic oscillator. So RSI oscillates between 0 and 100. Values above 70 are considered overbought and values below 30 are considered oversold. So when the RSI value is above 70, it suggests that the security may be overvalued and due for price correction, potentially indicating a sell signal. And when the RSI value is below 30, it suggests that the security may be undervalued and due for price rebound, potentially indicating a buy signal. For stochastic, the readings above 80 indicate that price is near its high, and readings below 20 indicate that prices are near the lows. A security is overbought when the K line moves above 80 and oversold when the K line moves below 20. So here is an example for stochastic. So how we like to use stochastic as well as RSI is by looking at hidden resistances, divergences as well, which we'll get into in a little bit. But we do have webinars on purely on divergences, so you could go and take a look at those as well. But I'll briefly go through those now. So what we mean by a hidden resistance is that on our stochastic, we see that we have multiple swing highs that line up nicely at this 93.52 line. And on our price chart, we have price making a higher high at each of these lines over here that we've highlighted. So this is what we mean by hidden resistance, and then we can expect price to continue to respect this level here. Okay, here's another example of a hidden support or resistance. So we see that we have, and once again, we are using a stochastic indicator. So we have a hidden support level in this case, and on our stochastic, and on our price chart, we have this increasing trend line. Okay, so just to recap, what makes a valid trend line is if there are three significant touches, and you can see that we are expecting price to continue to respect this line because firstly, we have this ascending trend line, secondly, we have a hidden resistance here. Okay, and you can see that's exactly what it did, pushed it all the way to our take profit. Okay, so over here is an example of how we are using multiple indicators. So here we have the trend line, that's the first indicator. Second indicator, we're using the stochastic hidden support level. And we are also using our horizontal levels, so support and resistance levels, swing highs and swing lows to, basically to find confluence and analyze or forecast that our prices are going to rise to our take profit level. Okay, so I mentioned earlier a bit about divergences. So here is the first example, which is a bearish divergence. So bearish divergence happens when an RSI or stochastic has a descending trend line, or descending or descending. If it's bullish divergence, then that would be ascending. So so here's an example, whereas on our price chart, we can see that price is either respecting a horizontal resistance or it is making a higher high. Okay, so in this case, we see that price is making is respecting a horizontal level. Okay, first point, price is testing a key horizontal resistance level with price making a smaller high, resulting in bearish divergence with RSI. Whereas on our RSI, we have a descending resistance line, which is basically descending trend line, and it caught the two reversals correctly, which you can see on our price chart. So what this forecast is that we could be seeing a reversal here as well. Okay, and you can see that's exactly what happened. Price reverses strongly because of the horizontal resistance, RSI resistance plus bearish divergence. And we can see that the RSI has also reversed very strongly. Okay, here's another example. Here is a little bit more straightforward. So we have price making a higher high and our stochastic making a lower high. Okay, and yeah, you can see that immediately after this divergence, price immediately dropped on on our price chart. Okay. Um, so this is an extension of the previous example. In this example, we see price immediately drop, but we can see that it's rising again and it's approaching our resistance level here. So it's approaching this resistance level and we see a repeated pattern with the ascending, or rather price making a higher high and stochastic making a lower high. So it's the same pattern. We also have a hidden resistance level between these two swing highs, and you can expect price to continue to drop, which is why we call it a bearish divergence. And that's exactly what happened over here. Okay, divergence potential. So in this example, we see that we want to take note of where the bearish divergence started. So that's why you place a vertical line over here, as well as where we intend it to approach. So in this case, we see the bearish divergence making a higher high from this level to here, whereas our RSI is making a lower high from here to here, which is why we place our vertical dotted lines at these areas. Um, Bearish divergence tells you that price is making a higher high, RSI is making a lower high. So we also highlight this area because price tends to reverse to the previous level where it started to diverge. So this is also basically a pullover, um in this case support level, okay, because we see that price is expected to pull back to this same level here, pull back or retrace back to this level. And you can see that's exactly what happened here. Price reversed to where the divergence started to occur. Okay. Now, forecasting breakouts. We see this ascending trend line and on both our price as well as our RSI. But on our RSI, we can see that price has recently broken out of this ascending trend line, which forecasts that price might we might observe the same thing over here. And you can see really close, if you look really closely, that price is barely breaking out of this ascending trend line, but also shows strong recent bearish divergence versus RSI. So we have a couple of pointers here that support our analysis that price is going to break out of this ascending trend line. Firstly, we have the RSI breakout over here. Secondly, we have the bearish divergence with price making a higher high and RSI making a lower low. Next, we have price breaking out of this ascending trend line here. And all of these points suggest that there is a high probability that our analysis that price is going to break out of this ascending trend line is actually going to happen, which you can see price broke and dropped strongly. Okay. Here's another example. In this case, we are seeing a descending. Okay, well, this is not a descending trend line because, as I mentioned earlier, we need 3 points for it to be considered a valid trend line. But this is a descending resistance line because we see these two swing highs on our price chart, and we also see the same two lines at the same spots for our RSI. Okay, so we see that our RSI is breaking out of this resistance level. Yeah, it's breaking out of this resistance level, and that's a suggestion or forecast that price is going to break out of this descending resistance as well. Okay. Okay, so price is now testing the descending resistance line. We're wondering if it's going to break it. Secondly, we have a descending line breakout, as we mentioned earlier, but we also have a bullish divergence. So, bullish divergence is basically the opposite of a bearish divergence. So we see that price is making a higher low on our RSI, and on our price chart, it's making a lower low. That's basically bullish divergence. So when you draw it out, it should look like this. Okay, so it suggests that price is going to continue to go upwards and break out of this descending resistance. Next, let's move on. So now we are looking at how we can play the continuation or breakout and reversal. Okay, so this is just a checklist for you to follow, especially if you are a beginner trader. It's just a good checklist to take note of a couple of things, or check for a couple of things when you are doing your analysis. Okay, so firstly, we have playing the continuation. Next, we're gonna look at playing the breakout. Okay, but we're looking at continuation first. So firstly, we want to see is price respecting Ichimoku. Secondly, is price respecting any trend line. Thirdly, is there any key horizontal support resistance level, Fibonacci levels that support these levels, and where's the next key level that it might go? Okay, so in this example, we are looking at a trend channel. So it's very obviously an ascending trend channel. What makes it valid is if there are two touches on top, two touches below, and you can see that it's continuing. So we are playing the continuation. What we mean by bounce and reversal in this case is not so much a reversal in trend, but more a reversal in terms of touching the walls of the trend channel. Okay, we see bounce off of the trend channel. That's basically what we mean by bounce and reversal in this case. Not so much breakout of the channel, and that's why we call it a continuation, because it's still continuing within the trend channel. So it's still moving within the trend, the ascending trend. Okay. Next, up on the other side, we are also looking at a descending trend channel just in the opposite direction. So we also see it bounce off of the walls of the trend channel just in a downward trend. Okay. Next, let's look at playing the breakout. So when we play the breakout, we mean crossing below the Ichimoku cloud, um, whether the momentum is in accordance to your analysis. Did price break any trend line? Did it break any recent key horizontal level? Or key Fibonacci confluence areas? And where is the next level that it could break out to? And then we fine tune it with Fibonacci levels and support and resistance areas. Okay, so in our first example, we are playing the breakout from this multiple swing high resistance. Okay, these tend to be areas more so than specific levels, which is why you can see that we've highlighted this area here. Okay, so price has broken out of it. We are expecting it to continue moving upwards for a couple of reasons. Firstly, we have this next swing high resistance here at the 135.147 level. Second point, we see it moving above the Ichimoku cloud, so suggests that it's a bullish signal. And then thirdly, we see that we have a 78.6% Fibonacci projection that also lines up with that same level. Once again, it doesn't have to line up exactly at the same level. I mean, it would be nice if it did, but these tend to be confluence areas more so than levels. So as long as it's near or close to it, that's fine. Okay, you can see that's exactly what happened here. So we moved above the 61.8% Fibonacci projection and move next, rise next to the next swing high resistance. Next, we have, in this case, a descending trend channel. Okay, so when we say breakout, you see it moving, still moving within the descending trend channel. So that's playing the continuation. But what we mean by breakout is you can see it's breaking out this ascending trend line. Okay, and it's also moving just below, or rather it's breaking out of the Ichimoku cloud. Okay. So we see this swing low support at the 1.03488 level, and we're expecting price to continue to drop to that level, which you can see it did nicely here. Okay, next, playing another breakout. In this case, it's breaking out of the ascending trend channel. So in this case, we are using an inverted Nike tick or a Fibonacci extension. So for Fibonacci extensions, we look for ticks, or Nike tick, or basically anything in the form of a V shape, as long as the tail of the V shape is longer than the head of the V shape like you see here. Okay, so in this case, it's kind of inverted. So we see the 127.2% level. That's where price is at now. And the 161.8 is at this swing low support here at 0.66420. So we're expecting price to break out of this 127.2 and continue heading towards our 0.66420 level. Okay, and in this drift, you see that price it does test the 127.2 level a little bit, but you see that it ultimately does break through and hit our 161.8% extension level as we expected. Okay. So in the next example, price recently broke out of the descending trend line. Okay, so we see it break out, and we're going for a buy entry at the 100% Fibonacci extension. Okay, once again, this is a Nike tick. I think you can see the tick a little bit clearer now. So we are expecting it, or we are projecting it to hit towards our take profit, as well as the 161.8 level. Okay, and you can see that's exactly what happened. So it does test the 127.2 level. So that's what we can kind of expect it to do. But ultimately, it would still hit our take profit. And it's not just by using the Nike tick or the Fibonacci extension strategy. We combine that with the upward momentum from breaking out of the descending trend line, and also from this buy entry and the take profit, which are all levels of swing lows and swing highs. So pretty significant levels to take note of as well. Okay, next we're gonna move on to correlation, but before that, let me know in the chat if you guys have any questions so far. Seems like we're all good. Let's move on to correlation. So when you're swing trading, correlation can be a pretty helpful strategy by comparing two different financial instruments or assets. So could be your stocks, currencies, commodities, so on and so forth. Okay. I mean, of course, in this case, we are talking about forex. So you can compare um two forex currencies that you're looking at in order to see or predict the different directions that they're heading towards. So a positive correlation means that the two assets move in the same direction, and negative correlation means that they move in opposite directions. And for example, if the price of gold and the value of the US dollar have a negative correlation, then when the price of gold goes up, the value of the US dollar typically goes down and vice versa. So the perfect positive correlation is +1 and a negative perfect correlation is -1. So in order for it to be considered strong correlation, we look for values of 0.8 and above or below -0.8. So basically 80%. Okay, so what exactly is it in the context of Forex and trading? So traders will use correlation analysis to identify potential trade opportunities and manage risk. So if a trader holds a long position in a Forex currency, they may want to consider taking a short position in a negatively correlated currency to offset some of the risk of the long position. So it's important to note that correlations can change over time, so traders must continually monitor their relationships. Additionally, correlation does not equal causation, meaning that just because two assets have a high correlation, it doesn't mean that one is causing the other to move. Okay, so here I have an example. My FX book has a correlation table that you can use to find the most or least correlated forex currencies in real time. So yeah, I've highlighted the time frames. You can choose if you're looking at a higher time frame, lower time frame. It's all there for you to adjust. And you can find currencies with correlations higher or lower than a certain percentage. So we typically will recommend looking for correlations higher than 80 and lower than -80%. So you just have to put that into the filter and you'll highlight all of the currency pairs that match up with what you have requested that you can see over here. So it's a very easy way of finding correlations. Okay, they have pretty much all of the major currencies as well as a couple of exotic ones. So you can go on to myfxbook.com and take a look and play around with the currencies on your own. There's another correlation table from CMC. Yeah, so just giving you examples that you can look at. So here are a couple of correlated currencies that are positively correlated. So we have firstly the AUDD and the Kiwi dollar, the euro and the pound, dollar index, CAD, and Swiss franc. Okay, so firstly we're going to look at the Australian dollar as well as the Swiss franc in this example, that is 84.2% positively correlated. So in this first chart, we're looking at AUDCHF, and this is what the chart looks like at that time in the 1 day time frame. And this is what the AUD chart looks like, also in the same time frame. So it's important that you want to use the same time frames to compare. And you can make use of the trading view feature that allows you to compare the charts at the same time. Okay, so yeah, so this is basically what it will look like if it is very correlated at that point in time. So you can see, yeah, whenever prices move upwards and downwards, it's basically about the same shape, I mean. Okay, and in this case, we are looking at pound dollar as well as the pound yen. And you can see that at this point in time, they are pretty much the same shape as well. So if you are analyzing the pound dollar, just solely by technical analysis, not taking into account any news events, any policy decisions. Just by looking at technical analysis, if you analyze on the pound dollar, you can pretty much implement the same analysis for your pound yen, since they are pretty much almost the same and very positively correlated in this at this point in time, in this example. Okay, but of course things do change and it's important to look at your fundamentals as well, which is why before you do this, it's important to look at the MyFX book um, correlation analysis so that you know exactly how correlated it is. Okay, another example, Kiwi dollar and Japanese yen, as well as the Aussie dollar and Japanese yen. So you can see once again that it's very positively correlated. Okay, another example, Kiwi dollar and Aussie dollar. You can see it's pretty much the same. Yeah. So if you can't see, it is a little bit difficult to see just by comparing these two charts, which is why we like to use the trading view feature that allows you to compare two charts on the same chart. Two currencies on the same chart. Okay. Okay, this is another example. We're comparing the SPX with the euro dollar, and you can see they are also positively correlated. I think you kind of get it by now, so let's move on to negatively correlated. So negatively correlated currencies, some examples tend to be the DXY and gold, as well as the DXY and the Aussie dollar. So in this example, we are looking at the Euro Aus and Aus franc, which are minus 90.9% correlated. Okay, so this is the Aus franc. Okay, and this is the euro dollar. So you can already see that these charts pretty much look nothing alike, and you can see that's exactly correct. So whenever prices are dropping on our euro dollar, our euro Aus, that's you can expect it to rise for our Aus franc and vice versa. Same thing in this example, we are looking at Aus dollar and dollar CAD. It's basically the opposite. Okay, and on the SPX and gold as well. So if you look at this chart, whatever you analyze on the SPX, just purely technical again, you can pretty much just reverse that for the gold analysis. So here is gold and US dollar, which tend to be negatively correlated a lot of the time. But of course, once again, remember to check before you do your analysis. Okay, and yeah, that brings us to the end of our webinar. Let me know in the chat if you guys have any questions, but if not, thank you guys so much for joining me today. Have a great rest of your week, and I will see you guys next week. Bye, everyone. Thanks, guys. Bye.